is in fact of a uh, a mutant nectarine, right? It's like an outcropping from a nectarine that had a funny growth on its side or whatever. It happens to look like a normal distribution when you look at it from a certain angle. Well, actually, kind of almost from any angle, because of the way that it's formed. It looks like a Monte Carlo, almost Monte Carlo normal distribution, made up of many thousands of geometric Brownian motion random walks. And to that, I say welcome and hello. Another fine episode. Oh, that's interesting. It's a very big. I'm standing in front of a very large, almost impossible to see cobweb. That's interesting. The only way you can even see it's there is because of all the little silkworms, or whatever kind of worms these are. The little green worms that are, I guess, making it and hanging from a tree. I guess it's not a cobweb, not a spider web anyway, but it's a web made of these tiny little strands from these little insects hanging off of this tree. Fascinating. I wonder if you can see them floating. Can you see them floating? Probably not. There's so many of them, but they're so tiny. I doubt the camera will pick that up very well. But who knows, maybe it will. If it does, well, there you go. See some little insects, green little insects. They almost look like, I don't know what they are, little green worms. But it's like this massive, there's thousands and thousands of them right there. They're just so tiny, most of them are practically invisible. You can only really see them because of the light shining, the sunlight, the early morning sunlight shining through the fibers or whatever that they're making, that they're dropping, as they were attached on the tree and now they've come down. That's very interesting. And they move obviously from the tree down certain ways and then back up, and they repeat that as often as they do. It's very interesting. Anyway, so yeah, that normal distribution pattern coupled together with a random walk, as we're having and as happens all the time, is kind of the thought I wanted to share with you today about Bitcoin and the Bitcoin Zig Zag. And when you ask me what is the Bitcoin Zig Zag, I will tell you. The Bitcoin Zig Zag, very simply, is literally quite what it implies, right? The returns of Bitcoin zigzag, as do the returns of any assets, right? All they do is move away from the mean of returns and then mean revert, right, to the mean of returns. That's all returns do. I mean, it's really quite that simple. You don't have to overcomplicate it. That's all returns do. What does price do? Price just follows the returns. The price doesn't necessarily mean revert. That's why we say price. It doesn't mean revert, because it doesn't necessarily. But returns do mean revert. We see that all the time. Once returns move a certain distance from the mean, eventually they mean revert. And by distance, I don't mean a number in price, obviously. I mean a number in returns that's related to the standard deviations of returns, right? Sometimes it mean reverts after getting not even to one standard deviation of return. Sometimes it'll deviate at the one, sometimes a little bit further, closer from wherever they do, but it is in fact those. Right. I don't know if that happened or not, but anyway. So, the mean of distributions, it is the returns that mean revert, obviously. We tell you that all the time in alpha trading. Now, why is that interesting? Why am I talking about it yet again? First of all, because probably most of you will never have heard me say that before, because this might probably be the first video you ever saw, or any of the other ones are the first ones you saw. So it doesn't matter which one you saw first. It's important for you to know that. Right? It's the kind of thing that never gets old in this space. It's like asking me, why does the weatherman tell you the weather? That's kind of his job, or her job, right? Returns mean revert. If you didn't know that, you're not trading properly. And that's normal that you don't understand that, because most people don't have a clue. They really don't know that actually returns mean revert. They think price mean reverts. It's not the price. Okay? It's the price that follows the returns, and it's not in lockstep on 100% of the candles. It's in lockstep on most of the candles, but not 100%, because of things like geometric Brownian motion. Excuse me, early morning babbling tongue. And it's because of randomness that sometimes you'll see the price action stumble out of lockstep with the returns, right? Because it's not 100%, because some random thing will happen. But eventually it will catch up with it, right? It will begin following it again. Because that's what price action does. If anything, and I say if anything, because it can do other things like random walks, right? So, but if it does anything semi-consistently or mostly consistently, it's more than semi, it's the overwhelming majority of the time, but still, if price action does anything relatively consistently, it's that it follows the returns. That's it. The returns mean revert. The returns move away from the mean. That's all the returns do. Now again, why is this interesting? Well, I've been telling you for a long time now, Bitcoin, I've been saying it for weeks actually, Bitcoin is highly probable to go sideways for a while until certain things in the RMLRs reset and the volatility resets and the entropy resets on certain time frames like the daily, etc. Right? Even the weekly, the 7-day. And it's entirely possible that we could see it go sideways the duration of the summer, right? With some movements here and there, some outliers, some things that do random things to the upside or the downside, or just some nice moves to the upside or the downside. But these last few weeks, seeing it go basically sideways is completely not a surprise. And that's why I keep saying, if you scalp low time frame volatility, entropy, probability, and statistics, it's these times when it goes sideways that are really your golden ticket, right? Because it's almost like the range of movement of the returns and the price action that it yields is very consistent and almost reliable. It's very tradable. You can scalp it. I can't say easily because of whatever. It's not supposed to say that, I guess. But it's easier than when it's only trending in one direction or the other, and you find yourself FOMOing in at the wrong moment or flooding out at the wrong moment, because that's what most people will do, right? They'll see it's trending, they'll buy a top, they'll see it revert, they'll sell the bottom. That's the reason most people lose money in trading, right? They wait too long to make the entry. They wait for the asset to actually make the move, and then once it reverts, because they bought at the wrong moment, boom, they freak out and they sell. If you think about it, it's quite logical that it happens that way. Why? Well, the reason people buy when they do, the reason they wait until a certain moment to buy, is because they see the asset running up, and they see it starting to slow down a little, and they think it's going to keep running that way. Of course, they don't have any idea about the VEPs, so they don't know if the volatility is indicating it's going to continue up. They don't know if the entropy is saying that. They have no idea. They don't know the divergence. But they see it slowing down a little bit. They think, oh, look, it ran up all this way, but it looks like it's settling off in order to run up a bit more. Well, they didn't see that the volatility told them it's actually going to turn around and dump. Right? That happens so often. And it's in both directions. Same thing if it drops really hard to the downside. That's the reason most traders buy at the wrong time. Plenty of traders buy at the wrong time for other reasons. And they'll buy during the run-up. They'll watch it rise. They won't take their profit when it's at the top or anywhere near it. They'll wait for it to turn around on them and eat away all their profits, and then they'll get into a serious loss. And that's when they'll sell out. And if they don't get wrecked, they lose a significant amount anyway. That's how people lose their positions. That's how people lose their liquidity. That's how people lose their ability to trade. Okay? If you want to increase your position size over time, the way you do it is you don't wait for the move to happen. You use leading information that tells you in advance this is probably going to happen. Once you see that that's probably going to happen, then you make that move. Right? You're essentially front running, but you're not really front running. You're just waiting for the leading information to tell you in advance, hey, you should be in this move now. How do you do that? Well, choose any time frame. Let's say you want to trade the 15-minute. Great. Look for the 15-minute. Look for the occurrence of opportunity. You'll see when it tells you, yep, this move is confirmed, go for it. But the way you actually get into position before it makes the move on the 15-minute is you chunk it down to the 9-minute, the 6-minute, look at the 10-minute, I don't care. Look at the 5-minute. Look at the 3-minute. Look at the 1-minute. You'll see as you get lower, things are happening more actively on those lower time frames because that's where the changes happen. The lower the time frame, faster the changes. Right? So you make your entry on the 10, the 5, the 6, the 9, the 3, the 1, whatever you're comfortable with. The time frame, right? Once you've done that, then you have a much better entry than if you just waited for it to confirm on the 15. The lower the time frame, the better your entry will be, theoretically, if you time it right. And the same thing for when you should get out. When you start to see that the 15-minute time frame is starting to end its move, you look at the lower time frames again. Right? This all should be part of your workflow. You should be zipping back and forth through the time frames to see when you should be entering the position and when you should be exiting the position. And once you see that the move is over or ending on whatever higher time frame you're monitoring with, you jump down again to the lower time frames, to time frames that are lower than the time frame you're trading, or at least if you're like on the 1 minute, you don't have lower than that on your chart for some reason, then jump down to that 1 minute time frame and look at what's happening, and make sure you get in out when the information says get out. Right? It's important to be able to monitor both sides of the time frame you're trading on, by the way. So if you're trading the 1 minute, even though I don't, when I trade the minute, I often don't look below it because I'm perfectly comfortable trading the 1 minute, but that's only because I've studied it for years and years. I still do occasionally look at the 30-second, the 15-second, but, I've done it for so long I don't really feel the need. But that doesn't mean that you shouldn't, especially if you're new. Okay? So even I do it. Let's just keep it that way. I don't not do it. Okay? I'm just saying, eventually, when you're practiced enough at anything, you get the feel for it. There are certain steps you can skip at some times, and then sometimes you have to do them anyway. Same thing is true with monitoring time frames. If you're trading the 5-minute, the 6-minute, the 3-minute, whatever, make sure you're able to look down below it to the 1 minute or the 3 minute or whatever is lower than your time frame, and that you look above it. right? So if you don't have access to lower than the 1 minute time frame, even though it's possible to still trade it, I highly recommend against it. Because if you can't see what's happening that's making the 1 minute time frame be the 1 minute time frame that it is, you're likely to get into a bad position. And you don't want to be in a bad position. So that is why you want to be able to see both sides of the time frame. But you want to see sides around both. You want to see time frames on both sides of the time frame you're actually trading. Does that make sense? Right? Because that'll give you a better perspective. That'll give you a better way, a better perspective, a more complete picture, a bigger picture of what you're actually trading than just the time frame you're on. Right? That you're trading. Because if you only look at the time frame you're trading, the reason we have a workflow from high to low time frames, the reason we start out every trading session looking at the high time frame, from however high it is on whatever asset you're looking on, could be years, could be months, could be days, weeks, whatever. Look at the high time frame and then work your way down to the low time frames where you're actually trading. Do that for every single asset you're actually trading on. Why? Because that way you have the big picture first. You see what's going on in the big picture, and then you zoom down to see what's happening on the specifics on the low time frames where you're actually doing the work. And that way in the back of your mind you know what is happening on the bigger picture, what is the general happening on the bigger picture, and you're aware of all the things happening through the different time frames as you move down to the lower time frames where you're actually trading. Why does that matter? Well, it matters because the returns zigzag. The returns move away from the mean, and the returns mean revert. All right. So the more aware you are of what the returns are doing on all the given time frames, the more you're aware of what your position should be on the lower time frames where you're trading in relation to where that stands on the higher time frames. Now you could say to me, well, your 1 minute trade has nothing to do with your hourly or time frame, let alone your 4 hour or your daily or your weekly or monthly or year. That's true, 100% true. But it does actually have a relationship. And you should know that relationship. All right, so if you know generally Bitcoin's been going up for 15 years. Does that mean you shouldn't short it ever? Obviously not. Obviously there's plenty of money to be made shorting Bitcoin. There's also plenty of money to be made longing Bitcoin. But you should be aware of the general tendency on the very high arc. And then you should be aware of the lower tendencies, the lower historical information on what it's done on, say, the quarterly, the monthly, 2 weeks, weekly, 5 day, 3 day, 2 day, 1 day, etc. What is it doing in general across those different time frames? And in the most relevant aspects, what is it doing since the last 30 candles on any of those time frames? Look a bit further out, look out 60 candles, 90 candles, whatever. Look out, right? Zoom out to get a broader perspective. But zoom in to get a more specific perspective. A more narrow cast to understand what's actually happening now. So that you can place your trade for what's happening now. And not just some random, this is happening in the big picture. It's going up, so I'm just going to long it. No. Like, this might be a moment where you need to short it. Or not be in a trade. Because it might just be going sideways and looking for the next occurrence of opportunity. Or it might be going short even, but it might be looking at an extremely small move that's not even worth entering and exiting. Right? It might be just like, it's going to dump down like 0.0001% and then bounce right back up. That happens all the time. Right? So, what to do with this information. Well, if you've learned how to trade volatility, probability, and statistics, I hope this has just been a refresher for you and that it's helped. If you haven't yet learned how to trade volatility, entropy, probability, and statistics, I once again invite you to enter the Alpha Trading Discord and learn for free. You can get free indicators that will teach you this information. Right? They'll show you this information. You get a free pre-populated chart with the indicators on them, the free indicators on them. Right? You can get free access to these indicators, and you can keep them and use them as long as you're in the Discord. Right? There's even one that's completely free, even if you're not in the Discord. It's all pre-populated on the chart, and we give that to you for free. And there's free tutorial videos, free, documentation about educational material we put together. Free access to the live chats, where you can ask people questions, by text, chat all your questions. You can share charts. You can ask questions about the indicators, about how to use them to trade. You can ask about your trading positions, whatever. You'll get consistent answers from our members, because our information, unlike traditional technical analysis, which is just a bunch of voodoo nonsense, our tools just work. So nobody's going to give you 3 different answers about how our tools work. Everyone who knows how to use our tools knows exactly how to tell you how to use them, because they all work. That's it. They do what they're supposed to do. That's all they do. And how you read them, you're supposed to know how to read them, right? How you read them is, once you learn how to read them, then you know how to read them. And then you know what actions you should take. That's just a matter of taking those right actions. But the tools, they all do the same things that they do all the time, right? There isn't a tool that only works 70% of the time. No, the tools work. Right? It's a matter of what you do with that information that matters. So if you want that, you just go to the Discord. The website for Alpha Trading is just alphatradinghq.com. Again, alphatradinghq.com. You click on the Discord link right there in the top area of the site, or you just go to alphatradinghq.com/Discord. Again, that's alphatradinghq.com/Discord, and that'll take you into the Discord. It's free to enter, and you just go ahead and open a request support ticket in the request support channel. Just ask for your free access to those free tools. We call it the volatility starter kit. It's free, and once you got that information, you're all hooked up with the educational information and everything else. Start asking questions. Right? Don't just get the tools and sit on it quietly. The more you ask, the faster you'll learn. The faster you learn, the better you'll be at this. Faster. Right? We get a lot of people who come into the Discord who just get the tools. They sound super excited about it when they ask for it. We tell them exactly what to do, and then we literally never hear from them again. They don't ask a single question. How are you going to learn if you don't ask a single question? It's silly that people do that, but they do it all the time. So, there's your opportunity, knocking, telling you, hey, if you want to trade, right, visit alphatradinghq.com/Discord. Once you learn how to do this, if you are actually a trader, or if you want to be a trader and you've been putting in a lot of time and effort, trying and failing, but you still have that energy to go, and you would just want to discover a better way to trade, well, this, in all probability, will change the way you trade. You can guarantee it'll change the way you trade. And once you learn this, there's no looking back. All right, that's it, guys and girls. Ladies and gentlemen, see you. Happy trading.